Hi, this is Matthew Cratter from Trader University, and today I want to talk about the perfect portfolio for this market. If you're interested in swing trading, day trading, momentum stocks, or just seeing what I am trading and how I'm positioned, be sure to hit that subscribe button. Now, I should say I'm going to tell you how I'm positioned, but none of this should be interpreted as investment advice. And what I'm going to show you is a little bit complicated, but a lot of you have been asking for it, so I thought, why not? Go ahead. So the first thing to know about this market is that momentum is working extremely well as it has worked in a long time. And so if you take a look, you can watch my previous video from January 9th about my favorite momentum stocks. I'll just briefly recap those right now. Google, Goldman Sachs, GS, Morgan Stanley, MS, Shopify, SHOP. You can see all of these hitting new all-time highs or new 52-week highs. PCTY, Paylocity, ANSS, and finally ServiceNow, NOW. So the momentum's working really, really well. So one way to trade this is just to be long a basket of these momentum stocks. Now, I like to use the 50-day moving average here as a stop loss. You can see in many of these that the 50-day moving average has moved pretty far away. And so you need to size it correctly. So if you're buying Google at 1480 roughly, and the 50-day moving average is at 1347, you got to size it such that if the stock goes from here down to here, you risk a fixed amount of your account. So call it 1% or 2% or whatever you do. Now, the other way to trade this that I like doing is I'll often use bull call spreads. So for example, if I'm bullish on Google, but I want to sort of limit my risk without using a stop loss, what I'll do is I will buy, for example, the 1480 call, and then I will sell a call to fund this at a higher strike price. So maybe I'll sell the 1485 call. And a bull call spread will reach its maximum profit if the stock is right at this upper bound, and that sort of caps your profit. But the nice thing about this is you're just risking some premium. So you have to pay to buy this call, the lower call. You fund it, you get a little bit of a rebate or a credit by selling the upper call, and then you profit from this movement here. And because you're not putting up a lot of capital, you can actually get fairly high returns. So that's another way of playing it if you don't want to have your stop all the way down here at the 50-day or the 200-day moving average. I like to buy stocks that are hitting new 52-week highs, new all-time highs, simply because these are stocks where there's often short squeezes, and the other nice thing about it is that there are many, everyone who owns the stock has a profit. And so there's like no overhead resistance or selling pressure from people who are trying to get out back to break even. So that's the first, sort of the first leg of this three-legged stool, and that is to be long momentum stocks. A very simple way to do it as well is you can be long the QQQs, either outright or in a leveraged using a leverage ETF for a short holding period, or maybe even something like the NASDAQ futures, the NQs. So that's want to be long momentum stocks in this environment. I'm not going to try to pick a top in it. I'm happy to trade with a trend. Now, the problem is what happens if there's a bad macro or foreign policy scare, as there was when the U.S. bombed Iran and killed Soleimani at the beginning of January. Well, in this case, what's going to happen is these momentum stocks are going to take a breather. And so the other two legs of the stool involve hedges. Now, the first hedge would be, well, let me back up and say that's one thing that can happen. That's one thing that can go wrong with your wrong momentum. Something bad could happen. You can get sort of a September 11th event. You can get some terrorist attack or some bad news that isn't baked in. That's the first thing that can happen. The other thing that we got to be cognizant of is we did have this yield curve inversion. Here's a chart of the yield curve. This is actually the yield on the 10-year note, the 10-year Treasury, minus the yield on the 2-year note. And you can see that over time, an inversion where it goes below zero, here, here, and here, have been followed by recessions and stock market crashes. So we had the early 90s one, we had the 2000 and 2002 one, and of course we had the great financial crisis in 2008 and 2009, all indicated by yield curve inversions. Now there was a lot of news I think it was last summer, maybe late last summer or midsummer, when the yield curve inverted again in the US. And there's a lot of explaining this away. Perhaps it does have to do with the Fed buying a lot of treasuries or various other pressures for foreign governments and foreign central banks buying treasuries. But either way, we've had this sort of trigger, and it should make people be a little bit more cautious, knowing that this, at least historically, has been a very good indicator to tell you 6 months, 1 year, 1.5 years out from the end of a bull market. And we've been having a very strong bull market since the bottom in March of 2009, coming up on, call it 11 years this March. So this bull market is very old in the tooth. That being said, when there's great momentum, when there's great trades, when you've got stocks like ServiceNow breaking out, and Morgan Stanley, even these old banks, old investment banks breaking out, I want to be participating in that, especially when these trends have been extremely smooth. You take a look at Apple, just been to the moon. So while we're doing this, we have to keep in mind what happened in early 2000, where there was kind of a similar melt up in very high beta names, risky names, all the dot-coms, etc. I'm not going to say that this is exactly the same situation. It's not quite as crazy, but we are seeing a melt up in names like Beyond Meat, Tesla, obviously, and we can debate whether these are short squeezes, whether there's been a fundamental change at the company. But these very speculative stocks, even the marijuana stocks, have begun to perk back up, like Canopy, for example. And so when we're long momentum, it's okay to be long momentum, but we want to perhaps have a hedge in our back pocket. And so the first hedge that I like is the 10-year note Treasury. Now there are two ways of trading this. You can trade it using the ETF IEF, which is the iShares Barclays 7 to 10 year Treasury bond ETF. So if interest rates go down, this will go up. You can see it's been obviously interest rates have moved down over the last 2 years quite a bit, as the Fed has sort of stopped raising rates, and we've been sort of sideways. If we get a recession, if we get a prolonged bear market or anything like that, even if one is anticipated, you will see a rally in this ETF. Now, the way I like to play it, so I don't tie up quite as much capital, so I can get a little bit more leverage, I like the 10-year note futures, which are traded at the CME. Now, futures are risky. Again, none of this is investment advice, but this is a nice way to play lower rates. And what it looks like in the U.S., if we look at just 10-year notes, TNX is a 10-year note yield. You can see there's just been there's really been a downtrend in this since 1980, 1982, whenever it was. Europe already has negative, or has had negative interest rates in various countries over the last couple years. And so there's a very good chance that the yields in the U.S. Go to zero, and maybe even go below zero. And so this is a nice thing to have on. In the last two bear markets in 2000 and in 2008, if you were long the 10-year treasuries, either the futures or you just own the cash treasuries or you were long one of these ETFs, it was a really nice hedge. So that's one way to hedge it. Likewise, if we go back, let's see if we can go back to, if this goes back to 2000 or 2008. Yeah, you can see here's 2007, where yields went from basically 5% down to 2%. And what that means, if you were long the treasuries or you were long IEF, you did very well. So that would be sort of the second leg of the stool. The first leg is long momentum stocks. The second leg is long treasuries, knowing that they're these nice long tailwinds with lower yields. Finally, one thing we should keep an eye on, something I'm keeping an eye on, is the Treasury, the central bank balance sheet. So here is really a 20-year view of the assets that the U.S. central bank, the Fed, holds on its balance sheet. And you can see it's really been quite amazing. We've gone from, call it 8, I'm going to get the scale of this wrong, but I think it's 800 billion here, up to 4 trillion roughly is where we are now. And you can see that this gray area right here is where the last recession was. And this is when the Fed, you can see the balance sheet was fairly stable. They cut interest rates, it still wasn't working. And so they had to start buying treasuries and mortgage backs and really growing the Fed balance sheet. And this has been one of the things driving this bull market. The Fed has expanded their balance sheet. And so you can see we've gone from, it's almost gone up 4x, call it. And what happened at the beginning of 2018 is the Fed began, well, let me scroll in a little bit here. So the Fed tried to sort of roll off their balance sheet at the end, starting at the end of 2017 into 2018. And this created a very bad hiccup in the markets. The market sold off for most of 2018 as the Fed deleveraged and sold their assets. So you can see these things are very correlated. And this is probably something I should keep a closer eye on than I have. But you can see that this, as soon as the Fed started, so basically this bottomed, this deleveraging stopped at the end of August in 2019. And since then, the Fed has grown their balance sheet just an amazing amount. And if it keeps going, if we look at the max here, you can see that at this rate, especially with all this stuff they've been doing in the repo market and otherwise growing their balance sheet, we could be hitting new highs on the Fed balance sheet. Now, why is this important? Well, this is important because the way the Fed does this is by printing money. They actually create US dollars out of nowhere, and then they go out on a shopping spree and buy all these assets. Very, very scary. And what it means is it devalues the US dollar. And so part of what we've seen over the last few years has not just been a growth in real productivity and technological advances, but we've also seen a devaluation of the US dollar. And this has shown up in higher housing prices, higher stock prices, higher junk bond prices, etc. And this is one of the reasons we're having such a violent rally upwards right now. So this is good. It's great to be making money in the stock market, but if you're holding dollars, you're gradually losing your purchasing power. The US dollar is being devalued all along. And so one way to hedge against this, and also to hedge against other macro risk, is to be long Bitcoin. Now, Bitcoin is nice because there's only 21 million Bitcoin, probably less than that because a lot have been lost or locked up. And so the nice thing about this, if Bitcoin survives, and it certainly looks like it's going to survive, it should continue to go up in this environment. As the US dollar gets devalued, Bitcoin goes up. Now, the other nice thing about Bitcoin, and the other reason I like how it fits into a portfolio like this, is that if you look at what happened when the Soleimani attacks in Iran, the Soleimani attack happened, is that Bitcoin immediately went up. So I think it was January 3rd that the U.S. bombed and killed this Iranian general. And then Bitcoin moved up. There we go. January 3rd is right here. And it's basically just gone up since then. So if there is some shock to the global system, it looks like Bitcoin is now functioning somewhat as a safe hedge. Obviously, Bitcoin is still risky. It's volatile. But I think it's got the same sort of tailwinds that gold has. This would be another way of, you can see here the spike in gold, which after the U.S. bombing Iran, you can see the gold spike. It's since somewhat pulled back. I like gold over the next 10 years. I basically like gold until Elon Musk and Jeff Bezos fly to some other planet or a comet and bring home a bunch of gold, which will then completely devalue it. But you can see the nice thing about Bitcoin as a hedge is that it has continued to go up with the stock market. It went up during the bombing of Iran. And so it's a very interesting hedge. It's got good tailwinds in the same way the U.S. Treasury notes, the 10-year Treasury notes have good tailwinds, but it also functions as a hedge. You can be sure if there's a terrorist attack or some terrible macro event that there will be a flight to safety, a flight to Bitcoin. At least that's how it's been behaving lately. And I believe just like Treasuries are in a secular uptrend, Bitcoin is in a secular uptrend. So that's the sort of the three stools the three legs of the stool: long momentum stocks, long tenure treasuries, and long Bitcoin. Now, what could blow up this portfolio? I call it the perfect portfolio for this market. Obviously, nothing is perfect. There's always risks. You got to be careful. I think the only thing that can really hurt this, obviously, momentum stocks can start to pull back. We might get stopped out. If you're using call spreads, it'll sort of stop you out automatically. But I think the one thing that could hurt this is an inflation surprise to the upside. If there's some wage growth number, some big inflation number, that will tank the stock market. That will tank tenure treasuries. And what it will mean, it will suggest that the Fed can't just keep buying assets forever and increasing their balance sheet. So I think that's the one sort of thing that could come out of left field. I think it's extremely unlikely. All the headline inflation numbers have been very low. There's obviously a lot of inflation in areas like healthcare, tuition, things like this. So I think it's a left field thing. That would be the one risk where all of these things lose money. Though there is a chance that in a highly inflationary environment that Bitcoin still does well. And I think Bitcoin will do very well for various fundamental reasons that have to do with the halving that's coming in May 2020, etc. So that's how I'm currently positioned. That's how I'm thinking about the markets. I'd be curious what you guys think about this. Leave me some comments. And if you found this helpful, be sure to hit that subscribe button. Hope you guys have a great weekend, and I'll see you in the next video.